If you want to buy a house in 2025 or 2026, relying solely on saving a 20% deposit in a standard bank account is a losing mathematical formula. Look at this chart comparing two financial realities. The blue line tracks the average person's savings capacity over 12 months. The red line maps property market growth over that same period. The gap between your cash and the market is widening every single month. If you project this data out, you hit a strict fork in the road. One path crashes into total financial ruin because of a rushed, uneducated purchase. The other maintains a steady, calculated climb into ownership. Every decision you make now comes down to a tight trade-off: the speed at which you enter the market versus the margin of safety you keep for yourself. To find the right balance, we are going to calculate the exact return on investment for the 10 most expensive structural and financial errors first home buyers make. The heaviest financial losses almost never happen in the heat of an auction. They are locked in months earlier, during the preparation and due diligence phases. This quadrant chart maps out pre-approval errors. We measure financial impact on the vertical axis against probability on the horizontal. Mistake number 1 lands in the high probability medium impact zone: missequencing debt, specifically taking out a car loan right before applying for a mortgage. A $30,000 car loan can reduce your total borrowing capacity by up to $100,000. You are trading a depreciating asset for the necessity of buying in an inferior suburb, or delaying homeownership entirely. Mistake number 2 sits high in both impact and probability: missing or misusing the first home guarantee. This policy allows you to buy with a 5% deposit and completely avoid paying lender's mortgage insurance. The trade-off is steep. Utilizing it means taking on a significantly larger total loan amount. That triggers higher monthly interest repayments and locks you into strict property price caps. Mistake number 3 is the most dangerous, landing straight in the ruinous impact quadrant, having zero hidden cost buffer. This happens when you pour 100% of your liquid savings directly into the deposit. If you operate with nothing left over, a single unexpected legal fee, a stamp duty miscalculation, or a $3,000 plumbing emergency forces you straight into high-interest credit card debt. These 3 pre-approval errors strip away your leverage and destroy your risk tolerance before you even attend your first open house. Once your finances are set, the active search begins. This is where emotional exhaustion sets in, and buyers start making expensive strategic missteps. Mistake number 4 is paying the hidden cost of waiting. Many buyers pause their search for 6 to 12 months, holding out for a reserve bank rate cut or a market crash. Let's look at the mathematical reality on this comparison matrix. On the left is the marginal dollar value of a 0.25% rate cut. On the right is the $50,000 surge in capital property growth that typically happens while you sit on the sidelines. Mistake number 5 is paying for unnecessary leverage. This matrix shows a $30,000 drain on your capital to hire a buyer's agent for an entry-level home, compared to the zero-cost alternative of building direct relationships with selling agents. Paying a premium saves you time on weekend inspections, but it severely depletes the liquid cash you desperately need for your deposit and emergency buffer. Mistake number 6 is ignoring sister suburbs to fixate on a specific prestige postcode. Forcing your way into a premium area with an entry-level budget guarantees you will overpay for a dilapidated property. That secures massive upcoming renovation costs and limits your immediate rental yield. Trying to over-optimize your search parameters or outsmart the market costs you time, and in property, time directly costs equity. If you survive the search, you hit the contract phase. This is where legal and structural risks peak. Mistake number 7 is making unconditional offers. Competing against multiple buyers at the final hour creates a huge temptation to waive your finance clause to secure the win. If you waive that clause and the bank's independent valuation falls short of your offer, you are on the hook for the cash difference. If you can't cover it, you lose your entire deposit and open yourself up to a lawsuit from the seller. Mistake number 8 is skimping on building and pest inspections. It is incredibly common to skip a $500 independent check to save cash and promise a faster settlement. Doing this executes a massive risk transfer. You assume 100% of the financial liability for hidden termite damage, bad water leaks, or foundation rot. Mistake number 9 is misunderstanding the cash rate versus the mortgage rate. The public assumes that when the Reserve Bank cuts the official cash rate, personal mortgage payments drop automatically. In reality, banks frequently retain those savings to pad their own margins. You must actively call your lender to negotiate or refinance to realize the financial benefit. Mistake number 10 is ignoring your leverage. New rules allow first home buyers to legally rent out a room in their primary residence. This strategy, known as house hacking, provides immediate secondary cash flow to service a high debt load. The trade-off is surrendering your personal privacy and navigating strict tenancy laws. Skipping due diligence clauses just for the sake of speed transforms government incentives into an unrecoverable six-figure debt trap. Overpaying for a property by $10,000 is a mistake you can recover from over time. Skipping a finance clause or buying a structural nightmare is permanent. This matrix maps 3 paths. The optimizer prioritizes early entry, utilizing the 5% scheme and renting rooms. The risk-averse trades prestige for a financial fortress, targeting sister suburbs with a 20% deposit. The hesitator? Stop waiting for rate cuts. Execute the purchase. Market pressures and timelines are heavily localized. Upcoming infrastructure events act as a ticking clock, artificially accelerating property prices for specific regions. Match your risk profile to your available capital. Protect your downside aggressively during the contract phase, and when the numbers align, execute the purchase without hesitation.